Indian Institute of Materials Management, IIMM, with its headquarters at Navi Mumbai, is a professional body of materials management recognized by Indian Society for Technical Education, ISTE, Ministry of Human Resource Development, MHRD, Department of Higher Education. The institute is a charter member of the International Federation of Purchasing and Supply Management, IFPSM, Finland, which has its roots in over 44 member countries. Through its wide network of 56 branches and 19 chapters having around 10,000 members drawing from public and private sectors, IIMM is dedicated to the promotion of the profession of materials management. Every year, Indian Institute of Materials Management celebrates Materials Management Day on 23rd April. The significance of this is on this day the Indian Institute of Materials Management was formed as All India body in 1975 with merger of following three professional associations. The National Association of Materials Management, which until 1966 was known as National Association of Purchasing Executives, the Materials Management Association of India, earlier known as Purchasing Officers Association, and the Material Management Association of Hyderabad. The merged body was called Indian Association of Material Management, IIMM, which was later changed to Indian Institute of Material Management, IIMM. The merger gave birth to an institution that in its current form is the only professionally recognized body for material management in India. IIMM Chennai branch is conducting 1-year diploma in supply chain management, DSCM, accredited by International Federation Purchasing and Supply Management, IFPSM, Finland. As a part of this 1-year diploma in supply chain management, DSCM, accredited by IFPSM, Finland, IIMM, Chennai branch conducting this webinar on GST for supply chain professionals. Trainer Mr. S.N. Panigrahi, Life Member and ex-NC, IIMM.
Fine. So good morning to all of you, all the delegates. So
Yes,
I'm,
very
Good morning, sir.
I'm S.N. Panigrahi. Let us start the sessions today. And this is for the GST for the supply chain professionals. And as I told you, I'm S.N. Panigrahi. This is my brief profile. I'm an international business consultant, corporate trainer, mentor, and author. I'm a electrical engineer with MBA and PhD diploma in TQM and ISO 9000. Over 30 years of corporate experience, and last more than 7 years, I'm into the consulting and training. I worked in Aditya Birla Group, OP Jindal and BC Jindal Group, then Tata Steel. Earlier it was the Bhushan Steel and Power, Sriram Group, Kalani Group, and so many. My last assignment was there in HSI Limited as a VP Commercial. And when my domain expertise into the project management and fitting forms of contract, that is my specialization. Then agile and project management, and this apart into the import and exports and also into the GST. And I'm certified PMP, authorized training partner, ATP instructor of PMI USA. I was in 2016 PMI India champion for 2 years. I'm a fellow institution of engineers and also chartered engineer, lead auditor, IMS, that includes about ISO 9001, ISO 14001 and ISO 45001. I am a lean and jet consultant and enterprise risk management practitioner. I am a certified Lean Six Sigma Black Belt from Exemplar Global as well as from the KPMG. I am a lean consultant, as I already told you, from the MSME, Government of India. Then I am trained in the COD, Center for Organizational Development, for 3.5 years on strategy and leadership. I done more than 450 workshops globally. Prior to COVID, I used to travel to Middle East most of the time, and I delivering the global workshops. Then more than 200 plus YouTube presentations are there, plus 150 plus slides presentations. These are in the public domain. You can see. You can Google search and say SN Panigrahi YouTube. Then you can find more than 200 plus YouTube presentations. I have published more than 500 articles in national and international journals, and I'm associated with many other institutes also. I'm a special invitee, Board of Studies, Symbiosis Center of Distance Learning, and also I'm adjunct faculty for the L&T. L&T has the institute, IPM, that is the Institute of Project Management, for the training of the engineers of the L&T. They are the institute. There I'm a faculty. And I was ex-faculty of the NIMSME also, and many other my associations. These are all my credentials. So now let us start the session. So basically, these are the topics we are proposed to cover on today's session. Okay. And what are the best possible? We will focus on the supply chain related transactions. Initially, first I will discuss about the basic concepts. Then mostly I will concentrate on the supply chain transactions. Though there are certain legal provisions I am mentioning, but legally law related will not discuss much because unnecessarily will complicate. So we discuss on the transactions how we can do in the supply chain, those we can focus. So this objective of this session is learning objectives is understanding the basic concepts of the GST, and there we have to understand about what is the supply, time of supply, place of supply, and value of supply, and what are the different type of supplies are there. Then taxable person and tax registration, the GST registration related, invoicing under the GST and e-way bill and input tax credits, and various other transactions under the GST we'll discuss. Then GST payment related briefly I will cover, and GST returns briefly, not too much. Okay, these are the learning objectives for this. The today's session is for the 2 hours starting from now, and because the 2 hours sitting may be certain painful, so intermediately after say around say 1 hour we can take a 5 minutes break. After the 5 minutes break, if you want all or with everybody's consent, we can take a group photo, then we'll continue with. And you are always welcome to interact anytime, need not be at the end of the session, but anytime if you have a doubts, you can raise the hand and you can interact with me. Okay, at the end of the session, of course, we have the question answers session will be there. And also you can raise the questions, we can clarify. Okay, so with this, no, there's a ground rules. Let us start with this session. So first we are understanding GST in India. Why the GST is required in India? Let us understand.
Why India needs GST? First, to avoid double taxation, that is, removal of multiple taxes and their cascading effect, and allow seamless flow of input tax credit. To usher in a nationwide level playing field, unifying taxes across India. To help ease of doing business. Simplified and unified tax system. Reduce interface with different departments to make total digitalization. Bring transparency in tax system. Easier compliance with lesser litigations. To simplify tax collection system and expand tax base. Increase tax GDP ratio. Enhance India's trade competitiveness by ensuring one nation, one tax, one market, and enabling free flow of supply. To improve efficiency and productivity in supply chain, resulting in business growth. Also to shift business from unorganized to organized, to make more efficient neutralization of taxes, especially for exports, and thereby improve export competitiveness.
Okay, so this is the basic. So I'm not further going on this concept. Okay, and then what is GST? Let us understand. GST, everybody knows this is about the goods and service tax, and this is one form of the indirect taxation on the manufacturing, sales, and consumption of goods. And actually, earlier there are different type of taxes are there. On manufacturing, we have a excise duty. On sales, we have a VAT and CST. On services, we have a service tax. And for the entry of the goods from one state to another state, for example, there is entry tax, like the different taxes we have. And all these taxes with introduction of the GST are merged and is become unified. Okay, that is the way happened from the 1st of July 2017, and it is a comprehensive one tax system for all the indirect taxes, and is a multi-stage taxation system also. How it is a multi-stage taxation, I will explain you further. And is also value added tax. What is the meaning of the value added tax also I will explain. And is a destination based taxation system. What is this? I will explain further. Okay. So this is how the GST, the meaning, basic understanding of the GST. We are not going from the legal aspect in more detail, but though I mentioned some of the legal provisions like sections and the rules and acts and other thing I will mention, but we are not more detailing with this law, but we are focusing on the understanding the basic concept and also how the transactions happens in the GST under the supply chain. Those things we will discuss. So as already I told you, there is a various taxes were there earlier before the introduction of the GST, like excise duty, there a VAT, then CST, then service tax, entry tax, like the many taxes are there. There are 17 different type of taxes were there earlier, and 23 cesses also available was there earlier. All those things are subsumed into one umbrella, that is a GST. Okay. So even though all the items are covered on the GST, some of the items are excluded from the GST purview, and those are like crude oil, petrol, then diesel, and aviation turbine fuel, electricity, and alcohol for human consumption. These are the items are kept outside the purview of the GST.
Excuse me, sir, why it is kept outside the purview, sir?
So various regions are there, sir. Economic and various other regions are there, and state we are the federal government governance. For example, alcohol, this is levied by the state governments traditionally, and this is the big revenue for the most of the states. For example, in Telangana, almost like 30% of the Telangana revenue is coming from the alcohol. So they don't want to lose that revenue, and it is goes to center also 50% if it goes to center and state, then unnecessarily states governments also losing that revenue, so they don't want to come into this year. Similarly,
Okay.
the petrol and other things also central government controls most of the things, and these have been distribution level, the state governments are involved to collect the VAT. So these are also big revenues for the state government through VAT, so they don't want to lose that revenue. So therefore the state governments are not interested to come into the central unified taxation system. So therefore these are being kept outside the GST purview. Very good, sir. Very good question. And like this, if you are interacting, the session will be more interesting. I always welcome for the interactive session. Like, okay, good.
Thank you, sir.
Thanks, sir. Then
Comments in
GST.
here.
Yes, sir.
Sorry to interrupt. Sir, what about water and milk, sir? Is there GST for water, raw water supply, and
Those
milk?
also I am talking, sir. The water, bread, or grains like rice and wheat, bread, and all these things also I will explain you.
Fine.
Except these things, all others comes under the GST. Except these things, all others are comes under GST. Okay, sir.
Okay, sir.
Okay. Now, as I told you, GST is a multi-tax system. Multiple tax means every stage of the supply, the tax will be levied. It is a single unified taxation system from the multiple taxes to unified, but each of the stage of the supplies, the tax will be levied. And it is a value added tax and multi-point tax. Those things I'll explain in the subsequent slide. Then it is about the consumption based or destination based taxation system. That is also I explained for the slides. It's a dual taxation, and supply is the basis for the collection of the taxes, and the time of supply, place of supply, value of supply, then the ITC credit means input tax credit, and who is the taxable person under registration, what are the necessary requirements, those things we will discuss. Okay. So this is how these are the topics we are now going to discuss further. First, I told you how the GST works. Simple, from a layman approach, I'll tell you. I'm not going much of the legal aspects. As from the beginning, I told, from the layman approach, let us understand. Suppose you are a business person. You have received of the materials. You are registered under the GST, and you are getting certain inputs like raw materials, packing materials, consumables, or some other capital goods you have received from a supplier, and then this is the taxable supply, for example. Then the supplier has to raise the tax invoice. Under the tax invoice, you are now entitled to take the ITC, means input tax credit. What are the tax you have paid? Sorry, sir. So the as a business person, you have collected certain material, purchased certain materials from the supplier, and he has made a supplies under the tax invoice for those taxable supplies. Then you are entitled to take the ITC. That is input tax credit, we call it. Okay. And when we are selling again, because you are business person and you are either manufacturing or you are a trader, and further those goods are being sold to your customer. So outward supply you are making, then again is a taxable, then you are collecting the tax from your customer under the GST, because GST is the indirect tax. Indirect tax is always collection basis, collected from your customers. Okay. And whatever you have collected the tax, you supposed to pay to the government. So you collected the tax from the customer and you supposed to pay the tax to the government, but you are taking the input tax credit to that amount, that raw materials and consumables or the other materials what you purchase from the supplier, and this ITC can be adjusted towards the output, the liability. Okay, what you are collected from the customer, on that the ITC you can adjust, and net only you have to pay, net tax you have to pay. So this is how the ITC provisions. Okay.
Sir, here, excuse me, sir. This purchaser and supplier, he's also paying GST here.
Yeah. Yes, sir. He is supposed to pay the GST. Now, then only he can collect the GST. Tax invoice is making means he is collecting tax from you. You are a business person. He is
Okay.
collecting the tax and he will pay to the government. Again, in the similar fashion, like. Okay. And next slide, in more details, I will explain you. There is a supplier, and supplier is make the supplies of the goods under the GST, under the tax invoice, and he collects the GST from you. You are a business person or the manufacturer or a trader, and what are the tax is collected, for example, invoice he raises like this: basic supply value is 100, and tax is, for example, GST, say assume it is 5%, and the net payment, the tax is means the tax invoice, the value is 105. 100 the value of the material or the services, and 5 is the tax, and 105 he is collecting from you. There the 5% tax is collected from you, and these what he collected, he is supposed to pay to the government. The supplier will make the payment to the government, the 5% tax what is collected. Okay. Yeah. So you are also business person, so you are selling the goods to customer. At that time you are raising the invoice, and here the tax whatever you have paid here, you are taking as a credit, and further you are making invoice raising. Suppose you are making the inward supply, you have received at the 105 this invoice, the material you received at the 105, and you have taken a tax, that ITT tax you have paid, but ITC credit you have taken, that can be reduced from your net payment, like. Okay. So net your cost becomes 100 now. You paid, means paid to the supplier 105, that includes the tax of 5%, 5 rupees, and that is allowed you as a tax credit, the input tax credit. So you have taken this credit, so net cost to you is 100. Now assume you are adding certain value of 50, either your manufacturer or you are adding certain profit to your business. So this all inclusion is a value addition, so 50. Now on the value addition, the total cost is now becomes you this 150. On that you are want to collect the tax from your customer. You are collecting the tax, again assume on the 5%, at the rate of 5%, then it is 7.5. On 150 you are collecting the tax 5%, 7.5 it comes. Now you are making the invoice at this rate to your customer. Okay. Now what are the tax you are collected, you supposed to pay to the government. because the tax what are the collected, that is goes to the government tax. Okay, so you have to pay to the government. So here the when you are supposed to pay the government 7.5, but you have taken a credit of 5 here. Your credit whatever you have paid the tax to the supplier, that you have taken a credit. So the net payment to the government is 7.5 minus this 5 what you have taken ITC credit. So net payment is 2.5, means you are paying to the government the net of 2.5 only. How you this 2.5 arrest? Because on the value addition, say 50 is value addition, on value addition only you are paying the tax. So it becomes 2.5 you are paying to the government. Is it now clear, sir?
So here, sir, just the supplier is paying to the government 5%,
Yeah.
and the business manufacturer also is also.
That is also he also maybe have the ITC credit and all thing. You can adjust that one.
Okay. It's a cascading.
And this to make you understand from this point of view, I made this chart. Okay. This transaction in other way also, for more details I will explain in the next slide. So the concept will be very clear. Suppose you are a fabric manufacturer, you are purchasing the cotton from the cotton supplier, for example. Okay, and he is making the supply at 100 and the tax is 5, so 105. He is supplying at the with this invoice he is supplying to you fabric manufacturer. Now the fabric manufacturer is further making the fabric and then supplying to the garment manufacturer. And at this stage, the fabric manufacturer, his invoice value is 105, and tax ITC tax credit what he has taken is 5. So net cost to him is 100, and he is adding value, that is the including of his profit and all thing, is 50. So he is making now supply to the garment manufacturer at 150. Again on the tax he has to collect, so 5% GST, 7.5 on 150, 5% is 7.5. So net tax value is 157.5 he is raising again on the garment manufacturer. Okay. Now out of this 150, the tax what is collected 7.5, but out of the 7.5 he is taken a credit of 5. So therefore net payment to the government it goes to, it is happens to be 2.5 only. Okay, because 7.5 minus the 5 is only 2.5 is paying to the government. Okay, the fabric manufacturer here. Okay, and how this 2.5 is arised? Because the GST we call as a value added tax. Here the value addition is made only 50. On 50 he has to pay the tax of 5%. So therefore it becomes 2.5. Therefore it is called as a value added tax, means on the value addition only we are making the payment of the tax, not on the total value, but only on the value addition we are making the payment. That is the meaning of the GST is a value added tax. Then again the garment manufacturer, he is receiving the invoice with 157.5, and there he has paid the tax of 7.5, that he has taken a credit 7.5. So for him the garment manufacturer the cost becomes 150. On that assume he is adding the value of the 60. So he want to sell at the 210. Now again on the tax on 210 it comes to 10.5. So he is making the invoice at this rate, means with the 220.5 he is making the invoice to the customer. He is a final customer. Okay. Now again the tax payable to the government is 10.5, but he has taken a credit of 7.5. Now the net payment is 3. So the 3 he has to pay. How the 3 is arranged? Begin again on the value addition. Value addition 60, on that 5%. So therefore the 3 what is happened, the tax payable is paid to the government. Okay. And now comes to the end consumer. End consumer don't have furtherance of business, because the input tax credit, the condition is whenever you are making the furtherance of business, means you are a business person and you are selling some goods or services, then only you are entitled to take the credit. Suppose you are not having any business, you yourself consuming, then there is no question of ITC. So here ITC is 0, you see, for the end consumer he can't take the ITC, and he is the invoice what is raised, inclusion of the tax, he has to take into the cost. Okay. So this is how the taxation system happens in under GST. So therefore, from this what we understood is the government how they receiving the tax. You see, first is net tax payment is the 5. Here the payment is got from the cotton yarn manufacturer. Then here in the next stage in the fabric manufacturer, the government receives the 2.5, and in the garment manufacturer he receives the tax of 3, and total if you make 10.5, the 10.5, that is what the exactly last invoice what the payment is been the tax is collected, exact the same amount is collected in different stages. Okay, the same amount is collected, but in a different stages it is received to the government in this fashion. So therefore, the GST is called as a multi-point taxation system, means every point of supply the tax will be collected, every point of supply the tax will be collected. So therefore, it is a multi-point taxation system, and is also GST is value added tax. As I told you here, on the value addition only tax is been paid. The value addition is here the 50, on the 50 only you are making the tax. So it is a value added tax. And it is a seamless credit is allowed as long as there is a furtherance of business. But at the end of the stage, here you see the customer is not getting the tax because there is no furtherance of business. So the essential condition for taking the ITC is furtherance of business, means further he has to make certain sales or supplies, then only he will be entitled to take the ITC, input tax credit. Then no credit is allowed at the end, as I told you, when there is no furtherance of business, no credit. Okay. Is it now clear, sir?
Sir, here the first person in the chain, because when he's purchasing
Okay.
some
That is
material,
also similar, like you can extend, because I started from the cotton yarn manufacturer, so I am
okay.
talking about this, and you can extend to any number of chains, because it
Hmm.
can happen in an n number of chain, because we are into calling the supply chain. Supply chain
Hmm.
means chain of supplies. There may be
Hmm.
hundreds of chains can happen. It need not be only 3. I am shown to you an example, but it can happen any number of chain. But the essence of the concept is every point of supply the tax has to be paid, the GST is supposed to be paid or levied, and GST is a value added tax, and value addition only as every point on the supply, on the value added point only will make the point payment, that's the value addition only, and it is a seamless credit is allowed throughout the supply chain. And also at the end of the supply, for example, when the supply chain breaks, then after there is no credit is allowed, because that is the end consumer, there the supply is breaking, so here he is not entitled for the ITC. Okay.
Sir, here the last one,
Yeah,
the FC customer, he
hmm.
is not getting any value. He is the last person.
He's lost. There is no further business with him. No, he is not into the business. He is not making any supplies to anybody else. He himself is consuming. So the
Okay.
chain is breaking here. The supply
Okay.
chain is breaking here. So therefore, he will not be entitled for the taking the ITC.
Okay, sir. Thank you.
Okay, good, good. So GST is a destination-based taxation system. Assume we are supplying this. There is a supplier in Gujarat, in Baroda, for example. From Baroda, he is supplying the materials to the materials or services, goods or services to a person in Mumbai, Maharashtra. So here what happened? Supplier is in Gujarat, but the recipient or the consumer is in the Maharashtra. The GST is a consumption-based taxation system. So therefore, the tax what have been collected by the supplier and is paid to the government, the tax will go to the Maharashtra government. It will not go to the originating state, the Gujarat. The tax will go to the Maharashtra. Okay, the state tax I'm talking. Okay, the state tax will go to the Maharashtra, not to the originating state of the Gujarat. Okay, so therefore this GST we call is a destination based taxation system or the consumption based taxation system. Okay. So then there's a interstate and intrastate transactions. Let us understand what is the intrastate transaction. First, we will discuss. Intrastate. Yes.
Can you repeat that destination-based concept?
Yeah. Destination-based taxation system means, for example, you are in Chennai and you are a supplier. You are selling to the customer in Karnataka, for example, in Bangalore. Okay. Then what are the tax you are paying to the GST portal is going to the portal, and from the portal the tax will be distributed. 50% goes to the center and 50% goes to the state. Now, which state the tax will go? The destination based taxation. So therefore, the destination is the materials are sent to the Bangalore, Karnataka. So Karnataka government will receive the payment, the 50% of the tax what you are paying. The supplier is making the payment, but he is making the payment to the GST portal. The portal is neutral, like it is not like central and it is not state like. It is like neutral. And from that it has been distributed, and 50% go to the central kitty and 50% goes to the destination state.
Okay, sir. Got it.
Good.
Sir, it will apply to for both countries also, sir, from country to another country.
No, countries I will tell you later, sir.
Okay.
Because if the GST is only within India, then therefore why we will pay the tax to the other country? This is within the India. Within the India we have to collect. The tax is applicable within India only. Okay. Then what are the other provisions? I'll tell you later when I come to the import and export provision. If time permits, I'll cover. Then I'll cover the concept.
Okay, sir. Thank you.
And this is the dual taxation system. Dual taxation system means both the state and central government levying the tax. For example, we are making the tax, means the supplies, both the supplier and the recipient or the consumer or the customer also within the same state. Then we call intrastate. For example, a person from the Chennai, he is a supplier, he is making the supply to the Coimbatore. Both these Chennai and Coimbatore are the same state. So this is called as the intrastate transaction. Under the intrastate transaction, there is a dual levy, means the central levy CGST will pay. There are two components in the tax GST. One is the CGST, means central tax, central GST. There is another is state GST. Both we have to pay CGST and SGST. Okay. And in case our state is not a state, actually it's a union territory, then instead of CGST, we have to pay the union territory tax. Like for example, Pondicherry. And Pondicherry, that is union territory, not a state. So therefore, the union territory tax has to be paid instead of the state tax. Okay. So this is how the dual tax we call it. And in case of the interstate, for example, you are selling the goods from Chennai to the Bangalore. Those are two different states. One is the Tamil Nadu and another is Karnataka. In such case, we call it the interstate transaction. Okay. Within the state, intra, and different states, intra. Okay. So interstate taxation, then only central government will receive the tax. That is about the IGST we call, means interstate transaction, that is the interstate GST. And once this is IGST is collected and it is bifurcated, again sharing, center get to 50% and the state will get the 50%. Here the state means the destination state. Here the state means the destination state, already I explained to you. So this is how the bifurcation happens. Okay. Is it now clear, sir? Dual taxation system?
Yes, sir. So it means those states which are consuming more, they will get more revenue.
Yeah, right, sir. That is why when the GST is introduced, some of the states like the Gujarat and Maharashtra and even Chennai also, more of the producing states, but the producing states, when they're supplying, they will not get any revenue because the revenue go to the states like Bihar. Not much of the means the production is there, but consumption is there. And like UP also and Chhattisgarh, there the consumptions are more, but manufacturing and all things are less. And in such cases, those states will be benefited. So therefore, when the GST is introduced, a lot of states are protested and they are losing the revenue. But anyhow, it is how all the states are agreed, and under the Jetli, that concept when the finance minister was there, and he managed this all the conflicts also between the states and all thing, but managed, and it's come to the from the parliament, it has been passed, and GST been started with from the 1st of July 2017. Okay. So next, let us understand of the supply, time of supply, and place of supply and value of supply. These are the basic essential concepts we have to understand for the GST. Okay. What is the supply? Let us understand. Means there are the four aspects on the supply we have to clearly understand. The taxable event is the supply. What is the event for the taxable event? Is the supply. Means whenever there is supply, the tax will be levied. When there is no supply, no tax. Okay. Then what is the supply? Let's understand later. That I will explain you. Okay. But it is the supply is the basis for the event for the taxation. Okay. Now the time when it is leviable. What is the time of the tax? The time has to be decided. So time of supply. Then the third one is where, whether it is interstate or intrastate, which is the destination state, and all things to determine, we have to understand of the place of supply. Then what is the value on which the tax will be levied? So the value of supply we have to understand. So the transaction value. So these are the four aspects we are now going to further understand. These are the basic essence for the any of the GST concept. Okay. So first is about the supply.
Sir, one doubt.
Yes, sir.
Sir, this input tax credit has to be taken case to case, or at the end of the month, or
no? Those things I will explain you further. The ITC, whatever you are taken, that you can take when you are filing the return. GST 3B at that time, you have to file the means you have to declare what are the eligible ITC. As per the declaration, it will be reflecting in your credit electronic credit ledger of the GST portal. Then accordingly you can take. Generally,
it need
what
not
happens?
to be invoice to invoice, right? It need not to be closed invoice to invoice.
No. Invoice to invoice, the provisions also there, but credit taking and utilization need not be invoice to invoice. Okay. The credit you can take as a lump sum, like what are the eligible, all the credits you can take. What are the you are getting the supplies from your suppliers or vendors or contractors, and what are the eligibility credit? That eligibility criteria is there as per the section 16 of the CGST Act. As per the eligibility, what you are declared in the GST 3B, the returns, accordingly you will get the credit. Okay. Is it clear, sir?
Yes, sir. Thank you.
Okay. So the time of supply as per the section 7, the taxable event is the supply. Supply means all type of supply, including about the sales, transfers, exchange, barter, licenses, rental, lease, disposal. Means even the scrap also you are selling also is treated as a supply. And transfers what we are making also, like branch transfer from one unit to another unit. For example, you have one branch in Chennai, another branch in Hyderabad in Telangana. When you are making the supply from the Chennai to Hyderabad, then also it is treated as a supply. Okay. Because interstate, distinct persons we call, those concepts all I will explain you more in detail. Now the time of supply means when the levy of the supply is starts, and based on this the payment also arises. The payment of GST arises based on the time of supply. Then the place of supply, the nature of goods we can understand. Nature of supply. Nature of supply means whether it is intrastate or interstate. Accordingly, if the intrastate, then within the state the transaction is happening, then the tax will be levied as a CGST and SGST. Okay. When the intrastate means between the two different states the transaction happening, then we have to collect IGST. So the nature of state, the nature of supply will be determined based on the place of supply. Okay. Then on what value we have to make the payment of the GST? That is the transaction value we call it, and on the transaction value we have to pay on the section 15 of the CGST Act. Okay, these are the basic provisions. Now further each of them let us understand what is supply. The supply is, as I told you, supply is all forms of supplies of the goods or services, both goods or services or both, which are in the course of the furtherance of business. When there is no furtherance of business, then there is no tax. Only when there is a furtherance of business, then tax will be levied. So the condition is very clearly mentioned is the furtherance of business. Okay, and when all forms of supplies they call, means all supplies whatever you are making, like including the sales or the transfers, lease, rental, disposal, whatever the supplies are there, all those things are called the forms of all forms of supplies or comes under the taxation. Okay, but there are certain inclusions and exclusions they made. The inclusions further they are telling here, the consideration they made in the first EC, the section they made all forms of supplies for a consideration. Consideration means there is a value exchange. The consideration means, for the example, we are selling and we are collecting the money from the buyer. So there is a consideration is the money transaction happens. Okay, so therefore the consideration is the monetary aspect or the value aspect which is been exchanged. Okay, and for all forms of supplies for the consideration are treated as a supply, and the addition also they made here in case of the import of services, even without the consideration also, whether for consideration is there, but for the furtherance or otherwise also, means when the consideration part is okay, but is a furtherance of business is relaxed here. You see here what has happened is, you are importing any of the services, for example, your children and all thing, they may be playing certain games. The games are also they are means those are from the outside the countries, for example, services, those are being downloaded and the tax is applicable, even though it is about the means furtherance of business or your own consumption, no furtherance of business, then also the tax is leviable. But this is a complicated aspect. How it is happens are separate. I will discuss, because there is a certain other players are there in India. They are liable to pay the tax. Okay. Then, even though without the consideration also, here the without consideration of the furtherance of business, we are considering the import of services for the consideration. Then it is a tax. And another provision they made, even though without consideration also, those are treated as a tax. Some cases like branch transfers. Between the branch transfers, there may not be monetary transactions happen. Monetary means the transaction not there. Even then, these are treated as services when it is interstate. Okay, like that other provisions are there in the Schedule 1. Means branch transfers covers under mostly under this. Okay, and then this is a provision is covers about the classification of the goods and services. Means what are treated as the goods and what are treated as the services. The classification is made very clearly. Earlier there was certain confusions were there when the software you are procuring, for example, and software is a product or a means that is a goods or services. There is a confusion was there. Lot of litigations were there. Even in Supreme Court also they made certain judgment, but confusing judgments. So therefore, to clarify what constitute the goods and what constitute the services, they made very clear this under this provision. Okay. Now, there are certain categories are there which are neither goods neither supplies. So these are the certain provisions they made like this. Okay, the neither goods and neither services, like sale of land or the sale of the building after the completion certificate is received. Those are treated either neither goods neither services. Therefore, the no GST is applicable here. Okay. Similarly, some of the non-taxable territories you are making the supplies or transaction happens outside the India, then also it is treated as a no GST is applicable. Okay. And also the employer employee, for example, you are receiving this salary also you are making the supply, means services you are providing to your organization, and in return you are getting the payment of the salary. but these also kept outside the GST, because these are neither goods or neither services, the provision they made, so that your salary will not be comes under the GST. Okay, like other provisions are there. So this is how the basic about the supply. Supply, as I told you, all forms of supplies we calling. So all forms of supply means either sales, transfers, or the barter trade. Barter trade means I am supplying you liquor, in return I am getting the water. So there is a value transaction happening, but monetarily we are not transacting. So those also covers under the GST. Okay. Then exchange of the goods, then leasing or the renting or the licenses or the disposal also treated as a supply. So all forms of supply means these are all the forms of the supplies. Okay, that is where the disposal means the scrap also you are selling, that is also comes under the supply. Even though without value means consideration also you are talking, then also tax is supposed to be levied.
Sir, excuse me, sir, here.
Yes, sir.
The rent means if somebody is receiving rent, then also
rental, yeah, rental also comes under, sir, subject to certain conditions. Residential and commercial and the values and all things, they put some break, caps. Accordingly, the tax is applicable. Suppose you are having a commercial place, you are given on a rent, then the tax is applicable. Even though you are not registered under GST, the other person has to collect the GST, means to deduct the GST under the means pay the GST under the reverse charge mechanism.
Sir, excuse me, sir.
Yes, sir.
So regarding
Sir,
disposal of the scrap, which can be reissued to condition whether it be levied or.
So disposal of scrap and all thing also subject to, means this is also treated as a supply. So therefore the tax is applicable, sir. That is also I am covering separately. The last one slide is there. I will covering this supply of this scrap and what are the rates are applicable also. I will inform you there.
Sir, for this disposal of supply, whether this ITC is applicable, sir?
Yeah,
how it will be calculated?
Those things also I will tell you, sir. ITC and all thing. Okay. So again, the supply means supply of goods or services or both, and these conditions are applicable for the supply. Supplies are made by a taxable person. The person who is making supply, he must be a taxable person, then only tax is applicable. Taxable person means who is registered under the GST, called as a taxable person, and who are registered under GST, and they only has to collect the tax. Okay. So that is the one condition. The other one is made in the course of furtherance of business. When the business is there, means you are selling or means all I told you, either selling and renting or leasing or transferring, like that, then transaction is there, then only the tax is applicable. Okay, that is treated as a supply, otherwise no. And it is made for the consideration, the money monetary part must be there, then it's treated. But exception is when the branch transfers and all things are there, then we even without the means consideration also treated as a tax, means a supply. Supply is the basis for the taxation, and the supply is made in the taxable territory. Taxable territory means within India. This is all in India only. So total in India means that includes of the Jammu and Kashmir also. Earlier, the tax provisions are not applicable to Jammu and Kashmir, like excise duty or service tax or the VATs and all things are not applicable to the this Jammu and Kashmir. But with effect from the 1st of July 2017, the GST covers total India, including the Jammu and Kashmir. Okay, and that supply must be taxable supply, then only it is treated as a supply. And as I told you, some transactions without even consideration or monetary consideration also treated as a supply, like branch transfers. Okay, the interstate branch transfers. So there are different type of supplies are there. Taxable supply, then taxable supply already I covered. All forms of supplies and tax are treated as supplies. And exempted supply, what is an exclusions, exempted supply. Then what is the zero rated supply? Then what is the composite supply and mixed supply? Then continuous supply, then outward and inward supplies, then interstate and intrastate, already I told you, okay, and deemed supply. These things again we'll discuss more in detail, so that then only the supply concept will be clear. The supply is, one is exempted supplies. Let us understand. Exempted supply means the supplies on which the rate of GST is nil, the tariff rate is nil. Those are called nil rate of supplies. Like for example, the grains, like for example, the rice or the wheat or the salt, jaggery, cereals, like pulses and all things. Those are the tariff rate is 0. Those are called as a nil rated supplies. Okay. And other one is wholly exempted supplies. Wholly exempted supply means originally there is a rate is there, but through a notification those are been exempted. The nil rate is originally in the tariff itself nil rate, the rate is nil, but wholly exempted taxes is through a notification they're made 0, means there no supply, exempted. Okay. For example, bread, fruits, milk, curd, like these items which are made through a notifications are called as a wholly exempted taxes. Okay. Then there is a non-taxable supplies also there. Non-taxable supply means which are been excluded from the GST purview, like already I told you, alcohol for human consumption and petroleum products like petrol, diesel, crude, aviation turbine fuel, and all these things, electricity also comes under the non-taxable supply. All these three put together we call exempted supply. All the three categories put together we call exempted supply. Now the zero rated supply. Zero rated supply means supplies which are made for the export, means out of the country, and supplies which we make to the SEZs, SEZ or SEZ developers, we call as a zero rated supply. Zero rated supply, a separate category why we made is for export and export purpose, the taxes should not be exported, because it's a global concept. Only goods and services can be exported, not the taxes. So therefore, unnecessarily tax levy should not be there. So therefore, under zero rated supply, even though outward supply is not subject to tax, but they are allowed to take the input tax credit. The input tax credit provision I told you, when there is a furtherance of business is there and further you are collecting the tax, then only input tax credit is allowed. If the outward supply is exempted supply or there is no furtherance of business, then ITC is not allowed. So exempted supply, ITC is not allowed. Even though zero rated supply, these exports, you're not making the tax payment, even then you are allowed to take the tax credit, because unnecessarily you should not be burdened with the tax. So therefore the ITC is allowed for the exports and supplies to SEZ and SEZ developers. Okay. So even though these are these are zero rated like exempted supplies, but this is a special category of the exempted supply where the ITC is allowed. Other exempted supply, you are not allowed to take the ITC. Then let us understand about the composite supply. In the composite supply, there's a multiple supplies are there, but single price has been collected. And the bundle of supplies are there, but single rate is collected. Some examples I'll tell you. You are taking a pack of a gift where there's a watch is there, a pen is there, and a wallet is there. A combination, one pack, but different items are there. So these type of things we call multiple supplies, but only single price is collected. Say 2000 rupees pack. That includes about the watch, a pen, and a wallet. Okay. Like these supplies we call a combination of supplies. And there is two types of supplies are there: composite supply and mixed supply. What is this? How it is differentiated? Let us understand. First criteria we have to understand is when the combined supplies are there, then whether it naturally bundled or not, we have to consider. Naturally bundled means in the normal course of trade, those are going together. For example, you are manufacturing certain T-shirts. Along with the T-shirt, there's a packing is there, primary packing is there. Both the T-shirt and packing go together always. You can't separate it. Even though packing material may be 5% tax is there and garment may be some extra percentage there, but both the together going always, which is the prime supply you have to understand. Okay. So therefore, if the naturally bundled, if it is S, then we call it a composite supply. Means always these products go together. Another one example I'll tell you, when you are making the supply of the goods to your customer on FOR basis. In the supply chain procurement, people must be knowing FOR means free on road. Means you are supplying the goods to the customers, the premises. That includes your goods itself, the worth of the goods, plus transport cost, and also loading, unloading also, which are agreed upon, that are included. Here the bundle of supplies are there. Means one is your goods itself, then the transportation is also a supply, then your means loading, unloading also involved cost, and all these things put together, you are have an agreement FOR. So here the tax, how they make levy, because the transportation different type of taxation is there, and the goods different type of transaction is there. So how that levy is being made? So therefore they made it is a composite supply. These are undivided. You can't divide it. FOR, you can't segregate transport and your material, like you can't transport. We can't segregate it. So they made it's called as a composite supply. Under the composite supply means it's naturally bundled. In the normal transactions, then naturally we can't divide it. In such cases, we call composite supply. Composite supply, the tax is levied on the principal supply. The principal supply is attracting, say, 18%. They on 18%, the tax for the total value, you have to make the payment. Okay, in the composite supply, you have to make the payment on the principal supply. For example, another example I tell you to easily to understand. You are taking the Rajdhani Express or the Vande Bharat. When you taking the ticket includes not only for the travel but also for the food provision also. So the food and travel both are clubbed together. You can't go to the counter and tell that I don't want food and separately you give me ticket. They don't give. So in the normal transactions, it always goes together. So those are called composite composite supply. And for the composite supply, the principal supply is, in case of the Rajdhani Express, the travel is the principal supply. On the principal supply, what is the tax? That tax is levied for the entire value of the supply. Okay, that is called as a composite supply. Then comes to the mixed supply. Mixed supply means certain times the gift packs and other things that they make, the chocolates they make, and ice creams they make, and cakes they give, and dry foods they give, and these type of combinations separately also you can avail it, and a combo pack also you can get it. Okay, and in such cases it is not naturally always goes together, but it can be separately made, like a pack of pen, wallet, and watch. These separately also available, and pack also available, but need not be always going together. You can separate it. Such type of transaction we call as a mixed type of supplies. Mixed type of supplies, which is the highest rate of these combinations, that rate has to be paid. For example, for the pen, the GST is 12%. For wallet, the GST is 5%. For the watch, the GST is 18%. Which is the highest after these three, out of the three? The highest is 18%. So as a pack of the 20,000, for example, that are 10,000 the packet, and on that the 18% has to be paid, even though certain items are like 5% and 12%, but the highest rate is 18% on the combo. So that 18% has to be paid for the total value of the item. So that is of the mixed supply.
How the ITC will be calculated, sir, for this?
Pardon, sir? ITC is not, as I told you, tax to invoice basis, item to item basis. As a whole, whatever you have purchased, when you are entitlement as per the section 16 means there should be furtherance of business, and the outward supply is subject to tax. When you are collecting the tax from the outward supply, then only input tax credit is allowed. So these are certain conditions are there. If the conditions are satisfied, then of course you can take the tax, the credit, and credit can be utilized for the any of the your outward supplies. It need not be always one-to-one transaction like. Okay. So therefore, when you're purchasing certain items like wallets, pen, and watches from somebody's suppliers, and you're making the packing, then whatever the supplies you received as a lump sum, you are taking the credit. The credit can be utilized when you are making the outward supplies. It need not be one-to-one linkage need not be made. Is it now clear, sir?
Noted, sir. Thank you.
Okay, good. Now let us understand the intrastate. Intrastate means the supplier is in, for example, in Hyderabad, Telangana, and the buyer is in Warangal, same again in the Telangana. Then both the supplier and the buyer or the customer are both are in the same state, then it's called intrastate. Intrastate transaction, then we have to pay the tax like CGST plus SGST, and both we have to pay separately, like okay, like CGST and SGST have to pay. This intrastate transaction. Okay. For example, the selling item is say 1,000 rupees. CGST is applicable. Say it is total is 18% taxation. So CGST is 9% at 1,000, and SGST also 9%. Total is 18%. So 90 had to pay the taxes separately, and we have to show separately in the invoice. Okay, like this. Okay. When the interstate, for example, interstate means the supplier is in Telangana, Hyderabad in Telangana, then the other person is in Bangalore. These are two different states. Then we call interstate. Interstate transactions, IGST has to be paid, and IGST once paid, it has to be, the circulation happens as I told, bifurcation. 50% goes to the central government and 50% goes to the destination states. Here in the destination state is Bangalore, that Karnataka. Karnataka government will get the 50% of the tax of this IGST, whatever collected, 18% basis, 180, 50% goes to the Karnataka government and 50% goes to the central government. Okay, this is how the interstate transaction IGST you are collecting. This is the invoice provision, like this you will make invoice. Then the deemed supply. Deemed supply means there is no consideration. For example, even then we told these are certain cases, these also treated as a supply. For example, branch transfers. Within the two different branches are there. You are one branch in Chennai, another branch in the Bangalore. From the Chennai to Bangalore, you are making the supplies. These are two different states. So therefore, this supply is considered as a supply and is called a deemed supply, even though monetary no consideration is there, but is treated as a deemed supply and tax is applicable. Okay, and barter trade also. Barter trade also, you are for example, you are giving certain item, for example, old ornaments and getting the new ornaments. This is like barter happening. Okay, even then also the tax is applicable on the transactions. Okay, because that value exchange is there between the two transactions. These are treated as two transactions and tax is applicable. So these are deemed supplies, like we call it. Okay. Then the B2B transaction and B2C transaction. B2B means business to business, you all know, and B2C means business to consumer, customer or the consumer. But in GST, B2B means registered person to registered person. Means the persons, both the buyer, supplier and buyer, both are registered under GST, then we call it a B2B transaction. Okay. And these are separated because B2B, B2C, because we have to make the returns in GSTR 1, separately we have to make the transactions. B2B transaction means both the buyer, supplier and buyer, both are registered under GST. Then the transaction is B2B. Separately, you have to show in the GSTR 1 returns. And similarly, B2C, there are two categories are there. B2C is small and large. B2C small means you are selling, you are a business which is registered under the GST, but the customer is not registered. That's called B2C. Okay. And here the small means the transactions up to 2.5 lakhs, the invoice wise the transaction is up to 2.5 lakhs, then it's called the small, B2C small, and the transaction value is more than 2.5 lakhs, then we call B2C large. Separately, this has to be declared in the GST 1. Therefore, this importance of the classification is coming into picture. Then the continuous supply. Continuous supply means, for example, in a certain part of the Delhi, Indraprastha gas is there. The gas is supplied through pipelines. Not through, you need not purchase the gas cylinder separately like each household, but apartments also they have the gas supply. Even in Hyderabad also, certain part of the Hyderabad there is a gas supply is there. Indraprastha is supplying for the quite long days, years for the Chennai, sorry, in Delhi. So those are called as a continuous supplies. Like electricity also you're getting the continuous supply. There's no break, like we are not like lot wise taking, but continuously throughout the day and night you are getting the supplies. So those are continuous supplies. Continuous supply, the difficulty is for the billing. How it is built, you know, very simple. Electricity, how it is being built, even though daily basis you're consuming day and night, when the person comes and takes your reading in the meter, the electric meter, the readings are taking. Based on the reading, they make the billing. The previous reading and the present reading, what is the difference? Accordingly, the billing is made and tax is being collected. Like similarly, here also gas supplies are there, for example. So these are called continuous supplies based on the statement which has been generated on any particular time of the consumption. Based on that, you have to raise the invoices. Okay, that is about the continuous goods. And services also, like annual maintenance services are there. Those continuously are maintaining throughout the year, like housekeeping or the machines and all things. Factories also you are giving some contract for the supplies of the services, housekeeping and all things. So those things, continuous supplies. And there also when you are making the breaking of the period, and period wise you have to make the means invoice has to be raised. Okay. The period may be as per the agreement, maybe you making the monthly breakup, and month wise you are making the breaking, or you can make it based on the service provisions what is agreed upon. So whenever you're making the period, the declaration, or you're making the statement, accordingly the invoice has to be raised. So that is about the continuous supply. Then the e-commerce, the operators, there are different type of e-commerce operations are there, especially for the food deliveries like Zomato and Swiggy. There certain complications happened. Then government brought a notification through which they made it that restaurant need not be collecting the tax, because many times the tax collection, non-collection, everything is mixed up. Some of the restaurants are not registered, and there are different type of provisions are there under GST for the restaurants. So therefore, the confusions are arising. So the government made a uniform. The restaurant need not collect any tax. Only the e-commerce operator, means Zomato, for example, they had to pay the tax at the rate of 5%. Here, the no ITC is allowed. No ITC is allowed. The restaurant need not be registered, because many of the restaurants are registered and not registered. Many combinations are there. So the confusion arising. So therefore, they made a uniform that only the e-commerce operator, the Zomato, for example, or Swiggy, they had to collect, they had to charge the tax at 5%. And of course, they're not allowed for taking any ITC. Okay. So this is how the e-commerce provision for the Zomato and the Swiggy. Now let us talk about the time of supply. Time of supply, there are broadly these provisions are there under section 12 and under section 13. And one is about the goods, other is for the services. One is the goods and other is for services. For the goods, when is making the movement, for example, then they made very clear at the time of the removal, or the before or at the time of the removal, the invoice has to be generated. The invoice has to be generated, and that is treated as the time of supply. Time of supply is very essential for the payment. Means which month it is falling. Suppose you make the supplies maybe in the month of say October, but you remove the goods, means the invoice is made for prior to that. For example, even certain times people are used to make invoice is made prior to the removal, but removal made after that. Maybe in the November 1st it happened the removal. So the time of supply is the date of invoice by the supplier. If the invoice is issued, then the last date when the supplies is made means legally bound to issue, that is the treated as a time of supply. Which of the earlier means the payment also made the one of the clause advance payment. But advance payment provision later I will discuss, because there is certain relaxation as given for the goods of supply, the time provisions for the in case of the advance payments, there is separate relaxation given. But otherwise in the law it talks about the earlier of the both, which are the invoice date or the payment which we receive the advance payment, that advance payment date, okay, which is the earliest, that is treated as the time of supply. And for the services, there are three provisions are there. One is about the date of issue of the invoice. The second is about the date of provision of the service. And the third one is when we are recorded in our books of accounts, the services has been received like that date. Out of these three, which are the earliest is taken in the time of supply. Time of supply as important, as I told you, it is for the levy we have to decide when that provisional supply becomes levied about the tax, and when the payment arises also determined by the time of supply. Then the place of supply. Place of supply determines the nature of supply. Nature of supply means whether it is interstate or intrastate, based on the place of supply. The thumb rule always I used to tell, in normal cases for the goods, for example, where the goods are being delivered. For example, you are the supplier in Chennai and you have made a supply of the goods to the Bangalore. The materials are reached at the Bangalore, that is in Karnataka. So the place of supply is in Karnataka. Okay, that is thumb rule always. Remember where the goods have been destined or where the goods are reached, that is the place of supply. Accordingly, you have to make the transaction, because it is the interstate transaction happened from Chennai to Bangalore, two different states. So interstate. Suppose you have made the supply from the Chennai to Coimbatore, both are within the same state. So it is called as a intrastate transaction. So for the place of supply is so important for determining the nature of goods. Accordingly, you have to make either interstate or intrastate. Accordingly, you have to make the invoicing. Okay. So these are the provisions. Under these, when the goods or movements are there, goods moved, then the supply to the direct to the recipient. For example, where this recipient, the place of the recipient or the place of the delivery where it has happened, that place is called place of supply. On the other hand, certain times what happens is there a third party transaction also happens. There's a supplier in Chennai, there's a buyer in Hyderabad. The buyer in Hyderabad tells to the supplier to deliver the goods to the Bangalore. So here the three different parties are there. One is the supplier and buyer, and the place where it is been delivered, that is a separate state. So in such cases where the goods have been delivered is taken as a place of supply, means it's delivered to the Bangalore, but it is actually principal place is the Hyderabad. So the Hyderabad place is the principal place supply, means the principals is related. So the transaction here is treated as between the Chennai and the Hyderabad. The place of supply is we are taking is Hyderabad, even though goods are being delivered to the Bangalore. Okay. Here the principal's place is taken as a place of supply in case of third party transactions. Okay. Like this, these are the basic. Other things not to complicate. Let us not go move. But the fundamental is, suppose the machines are being installed, where the machine is installed, the location of the good means the delivery is taken as a goods. In certain cases, it also happens that in commodity trading, there's a buyer and sellers are always will be there, but materials are not moving. Materials are not moving. Materials are there in the godown only. So therefore, the place of supply is in a godown place only. That is a godown place because the materials are not moved, but the transactions are happening between the buyers and sellers. Okay. So like this, place of supply is very important to understand the nature of supply. Okay. Now let us understand the value of supply. Value of supply is
Satish here.
Yes, sir.
Sir, I have a small doubt.
Yes, sir.
If the billing address, I'm billing a material in Tamil Nadu, I'm giving an order to supplier who is in Karnataka, and the place of the delivery is in Karnataka only, sir.
Now here you see the supply to the recipient on the direction of the third party. Very clearly that provision is made under the section 10.1.b. The principal place means who is for example, I told the example, you are supplier in Chennai and there's a buyer in Hyderabad, and the buyer is giving the direction to the supplier to deliver the goods to the Bangalore. But
that comes under interstate. But what I'm asking is, I'm going to give a purchase order to a guy who is in Karnataka, and he's going to deliver the material to a site which is in Karnataka. But I'm giving an order from Tamil Nadu by my billing address in Tamil Nadu GST.
Tamil Nadu you are made, sir. You are a purchaser. Is it right?
Yes,
okay, you are a purchaser, and the seller is in Bangalore.
Yes, sir.
Okay, you are asking him to deliver in Hyderabad, for example. Okay.
No, in Bangalore itself, sir. In Bangalore.
Okay, in Bangalore itself. Okay, wherever maybe it's Bangalore. Here the transaction originally how it is happening. You are a buyer in Chennai, and the supplier in Karnataka, and the transaction is with Bangalore to Chennai. Bangalore
to Bangalore.
No,
he is supplying the goods in Bangalore itself.
Let it be, sir. The invoice is raising on Chennai branch only, no, sir?
Yes, sir.
Yeah, so Chennai is the transaction happened, no?
Yes,
so
sir.
you are the buyer, even though you ask to deliver to somebody else or some other place, but you are the buyer. So the seller is in Bangalore, and Chennai, you are the buyer. So the transaction here happens in state. So he raises the invoice on your Chennai branch. Is it now clear?
Okay. Yes, clear.
Good, sir. Good. So the value of supply. Value of supply is the transaction value. What are the price you are declaring? Based on that price are the contractual agreements what we have. Based on that transaction is taken. Unless otherwise there is a provision is there. There's complication. That is why I told I don't go with the legal depth of the legality, because when the related persons are there, the provisions are different. If the persons are they're not related persons, means the same company or the same directors, that different units are there, are the related companies, there is a different definition there. Then if the related parties are there, the transaction value is not applicable. But if they're not related, then the transaction value means the value what you declared or what are you have the contract, that price is taken as that is a value of supply. On the transaction value only, you have to make the tax calculation supposed to made on this. Okay. And conditions, as I told you, there's no relation. Supplier and buyer are not related. And price is the sole consideration. Because certain times what people do is on the invoice value, they make certain transaction, but later on they'll give some discounts separately, some discounts or some other benefits they'll give. Then the transactions are treated again separately. That's the legal very detail we have to go. But here that is why the price is the sole consideration, but no further transaction happened related to this. Further, you are giving discounts and other thing not taken place like this. Then only the transaction value is taken as a value of the supply. Okay. Now, before going to this, can we make a small break of 5 minutes? Then we can come back and we can take the group photo. Is it okay to all?
Yes, sir, yes.
Okay. So let us break here for 5 minutes. then we can have a group photo. Then I will continue with the other subjects. And the second session is more important for the supply chain professional because I will cover with more of the transactions henceforth. Okay, can we take 1, 2, 3. So this is how the photos taken. Of course, I will share, or anybody is taken also can share. This is how the, so let us start with the subject. Subject we are talking at this stage, we are talking still in the concepts. Some more we'll discuss, then we'll move to the transactions. The taxable person under the GST and registration related, let us understand who is the taxable person. Taxable person means who is been registered under the GST is being talked about taxable person, or who is liable to be registered or liable to be registered. Some people, even though they are become liable, they don't register, and they also called as a taxable persons. Therefore, they have to collect the tax and they pay the tax. Okay. All the taxable persons supposed to collect the tax on their taxable supplies, and they have to pay to the tax to the government. Okay, and they have to file the returns also based on the transactions. Okay, and the registration is a mandatory requirement. Those who are taxable person means those threshold limits are crossed the 20 lakhs. That is the basic fundamental in the GST Act. Later, of course, certain relaxations and other exemptions and are there, but fundamentally it is about the 20 lakhs and above the annual turnover is there, finance year. The aggregate turnover is more than 20 lakhs, then they become liable to register. And registration based on the PAN based. So the registered person must have the PAN number, and also now some restrictions are made because the fake registrations happen for the taking the fake ITCs. Therefore, they make certain restriction that premises also they verify where you are declaring the offices or the premises of the factory and other transactions places, that also they verify. The mandatory requirement is PAN number, and it is state based first 2 digit. There are the actually 15 digit number. The GST registration is the 15 digit number, and the first 2 digits are related to the state code. State codes, like for example, these are the different state codes are there. Different state have different states. For examples, I have shown here. Odisha is 21, Tamil Nadu, for example, 33, Telangana 36, Andhra Pradesh 39, 37. Like this, different states have different codes are there. The first 2 digits related to the state code, followed by the PAN number. PAN number is a 10-digit code. So followed by then the 13th is, if in the same state you have a different branches or different units are there, then this 13th code can be used. For example, you are registered in Tamil Nadu, your office in Chennai, and also another factory is in Coimbatore, for example. For Coimbatore also you want to register, then that additional number is made. This 13 is for the additional for the branches and other thing you can make it. Then 14th was kept for the blank for the future use. At present it is blank. Okay, it generally goes with the Z. Okay. Then the 15th is about the some checks they made. This is the system based some controls they want to make. So therefore, this is logical code. They made the 15th code, 15th digit. So this is how the total 15 digit code is there for the registration. Okay, these are the state based registrations. State wise you have to register. Each of the state wide we have the codes are there, accordingly you have to register. For example, within the state you want to declare other branches, that is also possible. This provision is made, but state code will be remain the same, but additional provision they give the in here about the branches within the state. Okay. If you have a different state, different branches are there, and each of the state wise you have to take the registration. Each of the state wise you have to take the registration. Then as I told you, 20 lakhs, that threshold limit we call it. How they calculate the aggregate turnover, they're calling about annual aggregate turnover. Okay, the annual aggregate turnover is inclusive of the all taxable supplies, whatever you are making the taxable supplies, plus exempted supply also included. For example, you are a trader, you are making certain taxable supplies, like for example, some biscuits, snacks and all thing you are selling, that's the taxable supplies, or butter you are selling, taxable supply. Also you are selling the rice in a loose form, not a branded, and wheat and other things also you are selling, salt and other thing, which are not branded. So then those are called exempted supply. Even the exempted supply also included for the calculation of the turnover. And suppose the export also you are doing, export turnover also added here. And interstate transaction you are making from the one state to another state, your own branches, that transaction value also taken as a turnover. So the turnover is all inclusive of all these three, okay, all these four items are included, but excluding about the taxes. Taxes should not be included in the turnover. So the GST is excluded, and also what are the input tax credit you are paying, for example, reverse charge mechanism, that is also not included in the turnover. And what are the taxes you are paying, like CGST or SCST or UTGST and other thing, ITGST, these also not included in the turnover. Based on the turnover only, your liability arises. 20 lakhs is the threshold limit, but there are certain provisions are there where some states are agreed upon to make certain provision. For example, some of these special category states, in such case, the threshold limit they brought down to 20 lakhs. Not generally is 20 lakhs, but they brought down to special category states 10 lakhs. From 22, they brought down to 10 lakhs. What are those special states? Is these are the some of the special states from effective from the 2019. These are the effective state. These are treated as a special category states, and there the threshold limit is 10 lakhs. Okay. And then compulsory registration also there. Whenever you are making the interstate transaction from Chennai to say Bangalore, the interstate transaction, in such cases you have to register compulsorily under the mandatory registration, that is it, under section 24. There are certain exemptions also there. Suppose you are purely supplying exempted goods, like you are purely dealing with the rice only, which in the loose form without branding. In such cases, we call as those are exempted supplies. Even though you are making the 5 crores, 10 crores transactions, but you need not register with the GST because the entire transactions are under the exemption category. So therefore, under the section 23, you are exempted, you need not take the registration. And for the especially from the goods, for example, effective from the 1st of April 2019, they made certain provision exclusively for the goods, not for the services, but exclusively you are dealing with the goods. The turnover there is increased to up to 40 crores, 40 lakhs, sorry, up to 40 lakhs, not 20 lakhs, but 40 lakhs. But some states, not all the states, some of the exempted states are not covered under this provision. 40 lakhs is, these are the states. Like for example, Telangana, they're not agreed upon the 40 lakhs, they're continuing with the 20 lakhs. And these all states still for the goods also 20 lakhs. But other states like Chennai, Andhra Pradesh or Karnataka, they are going with the 40 lakhs turnover. Up to this, the dealer or the business person need not be registered up to turnover less than 40 lakhs. Okay. For the goods only, when they're dealing exclusively for the goods. Services continue with the 20 lakhs. Only for the goods, they made the 40 lakhs. Okay. But exemptions are there. These are the exemptions. Again, if you are selling the manufacturing ice creams or the pan masala and tobacco, these are the demerit items. Further, this 40 lakhs is not applicable. That is continuing with the 20 lakhs. Okay. So now let us understand with this composition scheme. Composition scheme is provided for the small traders or the business people, because small traders and business people with a lesser transaction value means that annual turnover may be less than 1.5 crores. For them, every month, like making the returns filing and all the invoices wise and all thing, keeping the details and all thing is very tedious. Therefore, they made this scheme, composition scheme, based on the turnover based transaction. Turnover means the annual turnover whose turnover is less than 1.5 crores, they can opt for this scheme. And there's a simple transactions are allowed, only quarterly returns you can file. You need not file the monthly returns of every month, like 2 returns, GSTR 1 and GSTR 3B, and various other transactions also you have to record and file, and annual transaction again you have to make the returns. So instead of only quarterly returns you can file here in this year. So therefore it is simplified, and also each of the item wise invoices and other things you need not raise, because in other transaction when you are taxable person, each of the transaction wise invoice has to be raised, but here those things are relaxed a little bit. And here what they are doing is the type of transactions, further the turnover is say up to 1.5 crores, then based on the type of transaction the tax is fixed, uniform tax they have to pay. For example, you are manufacturer and trader of the goods, then 1% tax you have to pay. If it is a CGST, 0.5%, and SCST, 0.5%, total 1% you have to pay. Suppose you are a restaurant not serving the alcohol, because again this clause is made demerit items. So if not serving the alcohol and your restaurant, then total is 5%, 2.5 plus 2.5. Suppose you are service provider, 3 plus 3, 6% you have to pay. On annual turnover basis only, this turnover like basis, if the turnover is less than 1.5, turnover basis only you have to pay the tax. The tax turnover has to be paid on quarterly basis, quarterly wise turnover you have to make. Accordingly, the filing of the GSTR 4, you have to make the filing of the return. Now let us understand of the invoice, because every transactions when you are making either buying, selling and all those things, invoice is a document through which you are making. But in GST, the invoice is mandatory when you are a registered person. And invoicing, there are restrictions are there. What are the some conditions are there for the invoicing? Let us understand. Invoices, when in general cases you are a registered person, you are again supplying to the buyer or supplier recipient, either they are registered or not registered, but you are a registered person, then you have to issue a invoice. The buyer may be registered or may not be registered, but you are a registered person, then you have to make a invoice mandatorily under the GST. Okay. Then suppose exempted supply you are making, then in such case instead of invoice you have to make the bill of supply. Instead of invoice you have to make a bill of supply when it is exempted supplies. And similarly, supplier is registered under the composition scheme. The composition scheme I told you, your turnover is less than 1.5 crores and you are registered under the composition scheme, then also you have to make the document, that is bill of supply, not the invoice, but bill of supply you have to make. Okay. Then for example, under the reverse charge mechanism, the recipient, they has to pay, not the supplier will make the tax payment and all thing, tax invoice, but the recipient has to pay on the self invoicing basis. So this is based on the self invoice. He himself has to make the recipient, he himself has to raise the invoice. Based on the invoice, he can take the credit also. Okay. So these are the invoicing provisions. Then invoice, there is a mandatory, these are the provisions are there on invoice. These are the terms, all these things must be there in the invoice. These are all mentioned. There are 16 fields are there. All these 16 fields are supposed to be there. Okay. And the invoice, the number is very important. They made up to 16 alphabets. The numerical and alphabets, both the combination, either alphabets or numericals or both the combinations with the special characters also, some special characters like this are allowed. You can make a invoice numbers. Okay. That is up to 16 the fields, 16 digits. Okay. And a sample like invoice I am showing here. When you are writing the tax invoice, you have to write the under the section 31 and the rule 46. And what type of transaction you are making, that is also we have to make a tick, like it is a B2B or B2C large or B2C small, like that you have to mention. And of course, the supplier, you are the supplier, you are the consigner, and your GST number means GST registration number you have to mention, and the invoice number, dates, and this consignee and other details, buyer details and all things you have to make. And very important is HSN code. Related to the HSN code, other things, of course, all the normal billing system is there, like quantity, unit of measurement, then currency and prices, value. Price means the rate per unit wise. Then what is the value, total value, and all thing you make. Accordingly, tax calculation also make. You have to make the tax payment. But the HSN code is very important for the GST transactions. The HSN code, later of course I'll tell you. Then let us understand here about the when that invoice has to be issued. For example, you are into the goods supply. On or before the date of the removal of the goods, in normal cases, you have to make the invoice. Suppose it is a continuous supply, when you are taking the recording, the statement, and based on the statement, you have to make the it's not removal, actually date of the statement. Okay. Now for the services, in normal cases, within 30 days from the date of the service provision, you have to raise the invoice within the 30 days of the service provision. Suppose in the provided by the banks and NBFCs, then 45 days is provided. In normal cases, it is about 30 days. Within the 30 days of the provision of the service, you have to raise the invoice. Okay. In case of the continuous supplies, as I told you, continuous supplies, when we are taking that recording of the statement, accordingly we can make the invoicing. Okay. Then the manner of issuing the supply invoices. In case of the goods, there should be 3 invoices we have to create. Like this, in a triplicate you have to develop. One for the original for the buyer, duplicate second copy is about the transporter, and the triplicate we can keep as our copy. This is for the goods. For the services, of course, 2 are enough. Duplicate only you have to do. Original goes to the suppliers, the customer or the recipient, and the duplicate we can keep ourselves. Okay. So that is what here again we are showing. Suppose you are making the supplies from supplier to the customer. The customer, you have to issue the original, the recipient, and the duplicate it has to go along with the transporter, and the triplicate you can keep along with you. That is for the goods supply. For the services, of course, only 2 are required. One is going to the customer, the original, duplicate you can keep yourself. So just a minute, here some gap is coming. Again, I will come back. Just a minute, sir. Because here some A is coming, blocking this field. Okay, this is blocking some place. That is what I am trying to avoid it. Okay. So this we have discussed. Then certain goods, like you are sending the goods for the job work, or you are sending the goods for the repairs and getting the returns. And in such cases, without invoice, you can send the goods under the delivery challan. Without this invoice, you can send under the delivery challan. Delivery challan also, there are certain provisions are there, and these are the some of the fields you have to create in the delivery challan. Okay. And manner of the issue of the delivery challan, again similar, like the original go to the consignee who is the recipient, and duplicate goes to along with the transporter, and of course the third copy we can keep ourselves. Then these are the GST invoice related. These are the laws and provisions. And HSN code and SSC code. HSN code is mandatory for certain values, up to certain values for the goods, and for the services, SSC code, service accounting code. Okay. HSN code, based on that, the rates and all things are determined. Based on the HSN code, each of the good items have certain HSN codes. Based on the HSN codes, the rates of GST has been declared. Accordingly, you have to make the payments and all, collect the tax, and you have to mention in the invoice the tax rate and tax amount. Accordingly, you have to collect the tax from your customers and pay to the government. Services, we have the service accounting code. Okay.
So, sir, excuse me, sir. Where from will you get, sir, this SSC code and HSN code? Is there any standard?
These standards are there, sir. If anybody wants also, I can share it. and also in portal also available, and in a Google search also you can say in for example clear tax, then there is also it is available. Any of the item you write and in the clear tax you can search, it is available to you. Okay.
Okay.
And the HSN code is a universal coding system, and it is was developed by the World Customs Authorities, Customs Organization. World Customs Organization developed this HSN code, and these are applicable for 98% of the world trade happens in this fashion. This universal coding, as I told you, so universally up to 6 digits is a uniformly applicable, up to 6 digits. But HSN code even beyond 6 digits are allowed. Based on the individual countries they can opt for it. But up to 6 digits, it is uniform across the world. Across the world, same that meaning and same interpretation up to 6 digits. And beyond the 6 digits, that's optional based on the countries they can adopt. India is adopted up to 8 digits for the import and exports only. For the GST, we are confining up to 6 digits, maximum 6 digits.
Is there a difference between HSN code import and HSN code local?
Sir, no difference, sir. Up to 6 digits, as I told you, these are universally, not only India, universally it is the same, up to 6 digits. Beyond the 6 digits, for import and export, we are added 2 more digits. Up to 8 digits we are going.
That base 6 digits will be the same, only 2 digits will be added in import export.
Yes, sir. Yes, sir. Yes, sir. Yes, sir. Yes, sir. And some countries like USA, America, and they have taken up to 10 digits. In China,
countries were having say 10 digits.
Some countries they have the 10 digits also, and some countries even 12 digits also. China, certain items they went up to 12 digits. Okay, but up to 6 digits uniform across the world. Okay? Every once in 5 years they are updating the HSN system, and present is HSN 2022 is the present system. Okay, and almost like 200 countries agreed upon. So all the transactions happens under the HSN coding only for the goods only. HSN is for the goods. Okay. And there are first 2 digits are related to the chapter, next 2 digits are related to the heading, and further 2 digits are related to the subheading. Then the national tariff levels, that is the NTL we call national tariff levels, that can be added based on the countries they opted for. Okay. Some countries up to 10 digits like that I told you, that is can be added, but basically up to the 6 digits is uniform across the world. Okay. There are 21 sections are there, 99 chapters, and these are many headings, and these are total subheadings. Okay. And some examples I'll tell you. Suppose milk and cream, milk and cream not concentrated and unsweetened. In such case, it is falls under the chapter 4, the 04. Okay, that's the first 2 digits about the chapter, and next 2 digits about the milk. Further is talk dairy products. Then it's milk and cream. Under the sub headings, there is the next 2 digit that 02, and further 2 digit 21 is about the non-concentrated and unsweetened. So therefore, for this item, the code is HSN code up to 6 digits is like this. Similarly, other items also you can see up to 6 digits I mentioned. These are the items like that you can see. Okay. Some more details also here given. These are for HSN code, and these are the service accounting codes. These are for the service accounting codes. This starts with in India, services like 99. You see, these are the first 2 digits about 99, and always the service accounting code we are opted for the 6 digits. Up to 6 digits, the service accounting codes. Different services, different codes are there. Okay. And in invoice, you have to mention the HSN code or the service accounting code, SAC code. Okay. Suppose your transactions are annual transaction, annual turnover, the aggregate turnover is up to 5 crores, means below 5 crores. Then the 4 digits is mandatory for B2B invoices. For B2B invoices means registered person to registered person. Both the buyer and seller both are registered under GST. Then when you are making the invoice, up to 4 digits you have to mention when your annual turnover is up to 5 crores. Suppose your annual turnover is 5 crores, but you are making the B2C transaction, this is optional. B2C is optional. Then your turnover is more than 5 crores, annual aggregate turnover more than 5 crores, and then you have to mandatorily follow 6 digits for all type of invoices, whether it is B2B or B2C, all type of invoices you have to follow with a 6-digit invoice HSN you have to mention in the invoice. For example, you are making any of the import and export transactions, then 8 digits you have to mention. In export invoice, you have to mention 8 digits. According the bill of shipping bill, you have to file. For that, you have to mention the 8 digits. Bill of entry you are making for imports, you have to make 8 digits HSN. Service codes up to 6 digits is compulsory whenever the service provisions are there invoice. And this is the 6 digits starting with 99. Okay. Then e-way bill. E-way bill provisions are made to control the transactions, because many of the transactions without invoicing and without transactions people are making movements. So to control it, e-way bill provisions are made. E-way bill provisions are mandatory when the supply is more than 50,000. When the goods supply, with the e-way bill about the goods only. So therefore, when the goods supply is more than 50,000, the transaction value of each of the transaction, each of the supply, for example, each of the transaction, the value is more than 50,000, then e-way bill is mandatory. And either the supplier or the buyer, or on authorization, the transporter also can generate e-way bill in a GST portal. Just a minute. Yeah, some people are there for waiting, that is why I am seeing. Okay. So this is the e-way bill provision. As I told you, when the transaction value, each of the transaction wise, the value is more than 50,000, then e-way bill is a mandatory. Either the supplier or the buyer, or on authorization, the transporter also can generate the e-way bill. E-way bill, the validity is up to say 200 kilometers in the normal transport, normal dimension transport. Up to 200 kilometers, 1 day is allowed. More than 200 kilometers, for each of the 200 kilometers, additional 1 day is allowed. For odd dimensional, for example, trailers are there, or some you are making the transport of the equipments or the machines which are odd dimensional, and odd dimensional transportation is there. In such cases, for 20 kilometers, up to 20 kilometers, 1 day, additional every 20 kilometers, another additional 1 day is allowed. Okay, this is how the validity about the e-way bill. And that these are the two parts are there in e-way bill as per the rule 138, and part A and part B. This is how the details has to be mentioned. The transaction related details have to mention in the part A, and this is the further exemptions also allowed. Certain goods, for example, your gas cylinders are being delivered. For that, there is no need for any e-way bill. Similarly, your household goods are being transported. For example, you are making shifting of the you are taking some services from the transporters, and your goods are being shifted from one house to another place. In such case also, this e-way bill is not required, and kerosene for that also not required, and postal transportation is happening, for that also not required. And then let us understand about what is the input tax credit. Input tax credit already we discussed. When you have a business person, you are registered under GST. When you are registered under GST, then only you can take the GST credit, ITC credit. You are getting the supplies from the suppliers. Those are taxable supplies under the tax invoice. Then ITC is allowed. Okay. And there is other provisions also there, need not be only tax invoice, even debit note or bill of entry and other provisions also made, that I will tell you later. Okay. So this is how you can take the ITC credit when there is a furtherance of business. That is very important. If you don't have the furtherance of business, you can't take the ITC credit. You must have the outward supplies. Those are taxable supplies. Then only you are allowed to take the ITC credit. Okay. Subject to, again, certain conditions are there, restrictions are there in the section 17. Some restrictions are there. What is the you are allowed under section 16? It is allowed, and section 17 certain restrictions are there. Okay. And you can take the tax of the input tax credit on the CGST, SGST, IGST or UTGST for all type of supplies which are taxable supplies, including also imported goods. IGST is applied in the bill of entry. Based on that also you can take. And also reverse charge mechanism, you are making the self invoicing. Based on that also you make the self invoice. Based on that you can take the credit on the reverse charge mechanism. So that input tax credit is allowed on all type of inputs which are taxable. The inputs subject, again, conditions are there, as I told you, 17 section 17 is the restrictions, but otherwise in general all type of inputs you are allowed to take the tax. And input services, inputs means the raw materials, consumables, packing materials, or the components, spares, and all these things you take the credit. Input services you can take the credit, and capital goods also you can take the credit. Okay. And all these things are furtherance to, means if you have a furtherance of business, then only you can take the credit, subject to, again, conditions. Okay. So these are the certain provisions are there as per the act for the input tax credit. Because as I told you, we are not going further, time is not allowed, and we are not going with the legalities. So these are the just I am mentioning, these are the certain sections for the input tax credit. Okay. And who can take the credit? Every registered person can take entitled for taking the credit. And to take the credit in the input tax charged by the supplier, when the invoices are there or any of the tax documents are there, based on that only you can take the tax the credit, and which are used or intended to be used in the furtherance of business, in the course or furtherance of business. This is very important. Then the said amount shall be credited to the electronic credit ledger. Once you are making the returns, then automatically it comes to your credit ledger. Then this provision they made, on which basis you can take the credit? On a tax invoice received from your suppliers, or on a debit note, or such any other tax paying documents, or in case of the, for example, imports, the bill of entry also allowed to take the credit. For reverse charge mechanism, on self invoicing you can take the credit. Okay. So these are the, already I told you, debit note, self invoicing in the reverse charge mechanism, invoices, or bill of entry in case of the imports, or IST. This is about the, if you have a different branches are there, your corporate office there in Delhi, you have a different branches are there in Chennai, Bangalore, and many other places. And on your behalf or the branch behalf, the corporate officers are dealing certain transactions. There they're receiving the credit. But the Delhi, there is no outward supplies, because Delhi is only corporate office. They're not supplying any goods or services. But goods and services are happening in the factory levels or branch levels. In such case, what happened? What are the credit that Delhi branch is taken? They are unable to utilize. So the provision is they made to transfer that credit into the branches on the proportionate basis. So for that provision, the ISD invoice has to be raised by the Delhi branch, the corporate office, to the branches where the credit can be taken. Okay. So they can utilize the credit. So for that purpose, IST invoice, on that basis also we can take the credit. Okay. So these are the certain eligibility criteria for the credit. But basically, I told you some restrictions, as I told you, under section 17. Those are blocked credit, we call it, ineligible for the ITC. So now coming to the payment mechanism, in this ledger, that GST portal, once you are registered, each of the registered person wise, the taxable person wise, there's a registers have been created in the portal itself. Transactions, all these are the electronic cash ledger. What are the payments you are making in favor of the GST, for example, the GST portal, and either through internet or banking or what are the other means you are making the payment, credit and debit cards through making the payment, it goes to the cash ledger. And on the returns filing, what are the eligible credits you are taken under the returns, and those have been automatically comes into your electronic credit ledger. And then liability ledger based on your GSTR1 transaction, because GSTR1 is outward transactions. Your returns you are filing under GSTR1, all the outward transactions you are declaring, and there you are making the payments also, you are declared what are the GSTs and all things. Those are liability for you. So the liability after the filing of the GSTR1 return, that automatically it comes to the liability ledger. Then the credit and liability ledger, you have to balance it. Net payment has to make to the government. When you are making the filing of the GST 3B, then you have to make the net payment based on the GST 3B. Okay. Then the reverse charge mechanism. Certain transactions we are taking on the reverse charge. Like for example, the goods transport services, GTA. GTA is most common in all our supply chain transactions. Buyer and supplier, you are making the transaction, the transport goods you are receiving. In this case, there's a provision they made that supplier of the goods, for example, the transporter, he is making the supply of the services by transporting, and they are the transporter generally, they are unorganized. There are certain organized sectors are there, but there are certain companies are there, there's unorganized. The transporters are unorganized mostly. And from that, the collection of the tax is very difficult. So therefore, the government, what they did is, the recipient has to pay the tax. The transporter will need not to pay tax and they need not register, but the recipient of the GTA, that transport of the goods and all things, the service, and the recipient has to make the payment. Okay. General transaction, it is happens like this. Okay. But in a reverse charge mechanism, the supplier may be unregistered, and the recipient, they have to make the reverse charge mechanism, self invoice. Based on the self invoice, they have to discharge the liability of the GST, and on the self invoice they can take the credit also. ITC credit can be taken. So that is what the reverse charge mechanism. Okay. And other, because time is a constraint, I'm not able to complete all these things, so I'm rushing a little bit. So the sales and purchase returns, most of the transactions, what happen because of the quality related, or sometimes you supplied extra items, the customer is not interested, he want to return it. Or you made certain supplies, the customer is rejected, you have to bring back. So in such transactions, how it is happens, let us understand. Okay. In such cases, the first option is like a fresh supply you are making, means there is a registered supplier is there. Both are registered here. Both the buyer and supplier, both are registered. Supplier is registered and buyer also registered. Supplier is making the tax invoice through which the supplies are made. But the buyer, he has rejected certain items. And in such case, he want to return the goods to the supplier back, and he made a returns. When he is making a return, one of the option is the buyer can take the credit as per the original invoice. Based on the original invoice, he can take the credit. And when he is returning certain goods, suppose 100 items are received, out of the 100 items, 20 items are rejected, and he is there sending the 20 items back. For the 20 items, 100 items is taken the ITC credit, total 100 items, what is received originally. And 20 items he is returning, for the 20 items, he can raise as a means separate like a fresh invoice on the same tax rate and same values, and he can return to the registered, the original supplier. So when the original supplier receiving is on the invoice, he can take the credit also. So it is nullifies. From the both the accounting and the GST provision wise, this transaction is very simple. Like you take the ITC credit for the total 100 items, and out of the 100 items, 20 items you are returning back. For the 20 items, you are raising the invoice, and the tax also you have to liable to pay. And this tax you are collecting from the original supplier. The value and tax you are collecting for the original supplier. From the accounting part also, originally this person, the supplier, is sent the 100 items and he got back 20 items back. Only 80 items like net supply is happened. The payment also he received for the 80 only now. You see, 80 only. And the tax also, that 80 he has taken back the tax part also here. So it nullifies about. Okay, this is the very simple transaction, very easy. We have the understanding. This is one option. The another option is issuing the credit note. The second option means the supplier is made a supplies and buyer is received, and he made certain returns of the goods. To that extent of the returned goods, the supplier is making the credit note to the buyer. So based on the credit note, the adjustment of the taxes can be done when you are making the returns filing. The credit note filing, the provision also there in the GST 1 filing. So accordingly, you can make the adjustment of the taxes. Okay. And this is how the one of the transaction you can do in the second option. Okay. Through credit note option. When they both the means the supplier and buyer are unregistered, then there's no question of the GST provisions at all. This is your own adjustment, your own understanding, how you are dealing with returns and credit notes and all the debit notes. You can deal, but nothing to do about the GST because both are unregistered. Okay. Then the credit note provision means the credit notes can be given in case of the rejections. So somebody is in because somebody is waiting in the waiting room like showing. The credit note provisions, the credit notes can be given by the supplier to the buyer only when, suppose in case of the quality related issues, in such case are the damaged goods and other thing, they are returning the goods back to the supplier, then the supplier has to give the credit note to the buyer. Okay. Or erroneously he charged some extra amount, for example, instead of say 100 rupees, he charged say 150 rupees. So the 50 rupees he has to give in separately a credit note to the buyer. Okay. So that is the credit note provisions. And credit note provisions, when they're making, the tax adjustment also has to be made, so that whenever the credit notes are being issued, the declaration has to be made in the GST 1 separately in the returns filing. Accordingly, the adjustment of the taxes and other thing can be done. So debit notes also provisions are there. In case of the debit notes means short collection. Instead of 100 rupees, he is collected only 80 rupees. So what has happened is originally he issued the invoice for the 80 rupees, but the value is say 100 So therefore, what he has to give the balance 20, he has to separately give the debit note to the buyer. The supplier has to give the debit note to the buyer. Okay. And there the GST also allowed, because originally is collected on 80 only the GST. When he is making the debit note for the balance 20, which is short collected, for that again he has to make the collect the GST and pay to the government. Okay. So the GST related, the debit note related GST provisions also there. He has to make separately the returns also accordingly. Okay. Now the job work, very important. Many of the transactions in buying and selling in a normal supply chain transaction, the job work also happens. The job work is the principal, he must be a registered person. That is the condition they made very mandatory in the GST. The principal must be registered, and he can send the goods or the service, goods or the any of the items like means raw materials or certain components and spares, or he can send the capital goods also under the job work. Under the intimation, earlier it is mandatory, but now it is removed because intimation is not happening. So that provision is relaxed. But without the payment of the tax, under the delivery challan, he can deliver the goods to the job worker. Okay. So this is how the principal must be registered, and he sends the goods to the job worker under the delivery challan because it's not tax invoice. If the tax is not being collected, no GST. So they had to send through delivery challan, and the job worker receives the job worker may be registered, may not be registered. Okay. And then it has been there after the job work, it has to be sent back to the principal. So then no GST is allowed. Again, he has to send under the delivery challan only, or he can send to another job worker also. Many times what happens, a series of job works happens. For example, you are into the garment industry, and you purchase the yarn from one supplier, and then you're sending to the some means a job worker for fabric manufacturing. From the fabric, you're sending to somebody else for dyeing. Then somebody else for again garment manufacturing. Most of the garment brand you see, they don't have any facilities for manufacturing, but only they are transacting under the job work only under that brand name. Okay, from the yarn to fabric, fabric to the dyeing, and dyeing to the garment manufacturing. All these things they do on the job works. Okay, so like one job worker to another job worker also can be allowed without payment of the tax and under the delivery challan. And again here the no delivery. After the job work, goods may be sent back to the principal or another job worker. And when the principal is sending to any of the customer, that time the GST liability arises, subject to taxability of the item. Okay. And in certain case, the principal also may export. In such case, the liability to discharge the taxes or the transaction has to be made under the certain provisions without payment under LUT or on payment of the GST. What are the options? There are two options are there for the export. Accordingly, you can opt for. Accordingly, you have to discharge the tax liabilities. Okay. So this is how the provisions are there made. Okay. So again, I'm repeating the same. From IIM Chennai, anybody is there? Some people are waiting. I'm not able to admit them. I'm clicking the admit all, but it's not happening. Can anybody help to bring them? Okay. Okay. So the job work, there's a principal. He must be a taxable person, means registered person. The job worker may be or may not be means registered person. Okay. And the goods or inputs or capital goods are received by the principal from his buying. Then he can take the ITC, and then he can deliver the same goods to the job worker under the delivery challan. Then within the prescribed period, they have to get back. So the raw materials are there or the inputs are there, then the materials has to come back after the job work within 1 year under the delivery challan without tax. In case of the capital goods, it has to return within the 3 years. Okay, this is the provisions. In case these are not being returned, because the job work is to get back the materials after the job work. In case the materials are not received as per the two provisions, in case of the inputs, it is a 1 year. In case of capital goods, machines and everything, it is a 3 years. In case it's not received, then it's treated as a deemed supply. In such case, the principal has to make the payment of the means GST payment has to be made, with interest also have to pay, because the liability happened when the materials are delivered from this point. From this point, it's been removed. From that point till now, that tax, what is the time is there on that interest rate also, 18% interest also pay. GST has to pay, on the original value of the items which we had delivered to the job worker, plus interest has to be paid if these are not received within this prescribed time frame. Okay. In case the job worker is registered, for the job work portion, not on the original value of the materials, but job work portion, the charges what he's charging, job work charges, on that he has to pay the tax. That GST tax is liable if the job worker is registered. Okay, this is about the job work related provisions. Now the branch transfers. The branch transfers happen, for example, you are in registered person and you have a different branches. One is at Chennai, registered under Chennai in Tamil Nadu. Another branch is in Hyderabad, registered under Telangana. So you're making the transaction from the Chennai to Hyderabad. Then this type of transaction we call as a distinct person transactions. Distinct persons means the same entity, means same company or organization register, means you're under the Companies Act, you're registered already under the Companies Act as a company. And same PAN number, then we call those people, means branches we call as a distinct persons. The transaction between the distinct persons is treated as a supply. And even though there is no consideration is there, but these are the deemed supply. So therefore the GST is applicable. When you're making the supply from the Chennai branch to the Hyderabad branch, both are registered and you have to pay the GST. Okay. Now advance payments. Certain times for the capital goods or certain items, the supplier wants certain payment, then only you make the delivery of the goods. So advance payments are normal practices happens in the transactions. So how to treat the advances, let us understand. Advance treatment, the complications happens because of the part payments that generally they make. Advance is not full payment, part payment of the say 20% advance, 30% advance, or 50, or certain times 100% even. But different type of transaction happens. Let us understand these things for the goods separately and the services separately. For the goods, suppose you made some advance payment on the 15th of October, 50% of the advance you have paid to the supplier, the buyer has made to the supplier. Suppose the supplies are happened on the subsequent month on the 5th of the November. You made the payment in the 15th October, but the materials they supplied on the 5th November. Then the transaction, how it is happened, because earlier there was certain confusions are there, but through a notification they removed the confusion. Now they made very clear, irrespective of the what amount of the advance you received and all thing, at the time of the removal, then only invoice has to be generated, and that date is considered as a time of supply. At the time of removal, you have to raise the invoice, and the invoice date to be issued on the 5th, because 5th you have removed the goods. So 5th you have to make the invoice, then in this date is considered as a time of supply. Okay, this is what the in normal life you have to make. Okay, but in case of the services, we have the service supplies. So here made the 15th of the October, the payment is made, some advance payment, and real services are being delivered or made the services on 5th of the November, and invoice is raised, for example, after the 15th November, they made the invoice. Now, out of these three, the three means advance payment and the provision of the service and the raise of the invoice. Out of the three, which is the earliest, that has to be taken as a time of supply. Out of these three, which is the earlier one, that has taken as a time of supply. Okay. So here is the 15th is received the advance payment, that is taken as the time of supply. So then pure supply, pure agent, some example I'll tell you. Certain times you are importing some goods, for example, but you are not dealing with the customs officials for the clearance of your imported goods. You are engaging some customs house agents or the customs brokers, and they are dealing on your behalf to clear the goods. In such cases, what happens is, for example, here I'm showing the example. the importer is there and the custom broker. On your behalf, the custom broker cleared the goods and he's paid certain payments to the shipping company, then port and the custom duty and transport and other things. They are paid some amount. The total bill amount is, for example, the broker charging a total bill amount is 1 lakh. Out of 1 lakh, 30,000 is paid to the shipping companies on your behalf, and 5,000 is paid to the port authorities on your behalf, and 45,000 custom duty is paid on your behalf, and transportation also is incurred certain cost of 10,000 on your behalf. So all these things, what is incurred on your behalf, on this unnecessarily there should not be any tax. So therefore, what they did is only the services which is he is charging, his service the customs broker service charges, on the tax will be applicable, not on the other expenses which is incurred on your behalf. He need not be taxed. So the broker has to make the invoice in this fashion, separating which are the he paid on your behalf, separately had to show, and what is his agency services, that he has to show separately. On the agency services only he has to collect the tax. Okay, so this is about the pure agent related services it has happened. Okay, clear, sir?
Yes, sir.
Okay, good. So of course, sometime I'm taking extra because I want to clear some more important transactions. So that is why I'm clearing it. So sorry for actually 2 hours, but it is taken more than 2 hours because some other transaction I want to clarify with you, because you are all supply chain professionals. It's okay. The scrap, scrap is treated as a supply. And there are different scraps, the different rates are there. These are the, for example, some of the rates as per the council decisions, and we have to pay the taxes. For example, the MS scrap, all type of MS scrap, 18% is the tax. Even MS finished goods also, like MS rods, for example, TMT rods, or the sheets, the 18% is applicable. Even scrap also 18%. Okay. Even the scrap means some broken scrap is, the definition is ununiform items are there. It may be reused. Scrap is anyhow reused, but there's unevenness is there. So those are treated as a scrap. So therefore, the scrap also, there's a certain rates are there, different scraps are different rates. And especially when it comes to municipality waste and sewerage waste and clinical waste, that also value to it, but they made it 0 because they have to encourage the waste treatment. Because most of the municipal waste and clinical waste, hospital waste, the treatment is very important. Otherwise, a lot of spread of the diseases and all things can happen. So they're encouraging the treatment, further treatment of the waste. Therefore, they made it 0. Okay. So these are the certain rates for the GST scrap. Scrap is also treated as a supply. As I told you in the beginning, that disposal, scrap, and all these things are treated as 0. Sorry.
Yeah. HSN code is used for scrap. Huh?
Yeah, these are different codes are mentioned, sir.
But it is 4 digit.
4 digits, sir. Additionally, you can add it. Additionally, you can add with which are available. You can add it, or if you want anything, also I can help you. If you want any of the particular specific you tell, I can tell you, give you details. Otherwise, in internet, if you go to the clear tax, it is available. You can go through it, or in the website of the CBIC. CBIC is the customs portal, customs and indirect tax portal, and there you can also search and you can find it. Okay. So the sales discounts. When the sales discounts, this is a very interesting chapter and very interesting also to know. Many times what happen in the market, general market, if you go into the shopping mall, you can buy 3 soaps, and for that buy 2, 1 free. Means you are buying actually 2 soaps and 1 is a free. So many transactions are there extra, 25% extra. Chips you are purchasing, for example, at 25% extra is there. Some snacks are there, 30% extra there right in the corner. So that is to attract the sales promotion. They do this type of transactions. But in this transaction, the government is made very clear what are the value you are collecting on the tax supposed to be paid. Suppose you are making a combo of 3 soaps, buy 2, 1 free, means a combo of 3. For 3, you are charging say 200 rupees. Even though you're calling is a buy 2 and 1 get 1 free, but total combo pack, the value is 200. On 200, the tax has to be paid. And input tax credit also, to that extent, we can take also. Because generally what happened, when you are making any free supplies, on free supply, ITC is not allowed. Exempted goods, ITC is not allowed. Because ITC is allowed only when there is a furtherance of business and subject to tax payment. If both are not there, then there is no ITC. Or any of these are not there also, ITC is not allowed. Suppose you are giving some free of cost, some goods freely, you are giving them like a gifts, then there will not be any tax. Though for the promotion purpose, the company talks about the free, buy 1, get 1 free, that is not actually free. It is also the cost is included in the combo. So therefore, the government, what they did is, whatever you're charging, say 200 rupees they're charging, on 200 rupees tax is paid, and the credit also to that extent they can take. Okay, means all the 3 combo, the credit can be taken. Otherwise, the complication happens when the one item is not is given a free. On free, there is no ITC, then ITC calculation and other things complicates. So therefore, the government made a uniform, like whatever you're charging, even extra you're talking 25% extra free you're talking, that's actually not a free, but is included in the overall price. So therefore, it is allowed to take credit also for them. Okay, they can take the credit, and on the overall price they have to pay the tax. When it's free gifts, of course, there is no consideration. When there is no consideration, then there is no ITC is also allowed. No ITC is allowed. Okay. When certain goods are given for the free for the promotion purpose, then the government has a view that these are not actually free, but for the promotion purpose. So therefore, those are treated as a taxable supplies. And when these are taxable supplies, then input tax credit is allowed. Okay. Get 1 free and all things I told you, buy 1, get 1 free, or all these things. This is how they do it. Okay. So like this, many transactions are there here in this year, discounts and all things. Discount provision, I'll tell you one thing. If these have been declared in the invoice, so about these are known at the time of the delivery itself, or the removal of the goods itself, we know there the tax is the deduction allowed. For example, you are selling the certain items at 100 rupees, and at the time itself, you and the buyer has negotiated, and you are extending say 10% discount. So therefore, you are declaring in the invoice 100 minus 10 the discount. So net is 90. On 90 only tax has to be paid. On 90 only tax has to be paid, even though original value is say 100, but the net value you are declared at the time of invoice itself, you know it, then the deduction is allowed. Means that 10 per 10, whatever you are given the deduction, on that tax will not be applicable. Only net is 90. On 90, tax has to be paid. Okay. But certain times the transaction happens at the invoice, you are charging with 100 only, but subsequently after 6 months or 1 year, or even certain times after 3 months, like that, you are giving certain discounts. That sales discounts happen on the volume based. The volume is not determined at the time of the transaction, so that you don't know that volume. You are not declaring the invoice. In invoice, you are collecting 100 only, but subsequently you are giving certain 10% or 20% discounts later based on the volume of the buyer's purchases. In such cases, if the earlier to that, there is certain document is there, contract is there signed, and agreement is there prior to that about the discounts, then when you are giving the discount, the credit notes and all things given, then the of course that tax you need not pay for that. you can take the credit note. Accordingly, a tax adjustment can be done. Okay. When there is known, prior certain agreements are there. But suppose there is no agreement at all, no prior agreement and all thing, then of course you're not able to allow to take the deduction of the discounts if there is no prior agreements. Then buy one and all thing I told you. Then the goods lost or stolen or destroyed. Many times what happened in warehouse, we are purchasing say 100 items, certain 2 or 3 items may be spoiled, or some theft has happened, or some fire accident and all thing happened, we lost something things. But from the point of the GST, to that extent, you have to reverse the ITC, because ITC you are taken when you're purchasing say 100 items, on 100 items you are taking the ITC, but you are declaring that some 10 items are spoiled or in the fire accident is burned. For example, you are declaring, but the government is telling no, nothing to do about. When these are, you are not using this for the furtherance of business, so therefore you are not allowed for taking the ITC. So you have to reverse the ITC. To that extent of the what are the goods you lost or stolen or destroyed or burned somewhere, and to that extent you have to make the reversal of the ITC. Of course, you can allow to take the insurance and all thing, that is a separate issue. From the GST point of view, you're not allowed to take the ITC. So therefore, when such goods lost or stolen or destroyed is there, you have to reverse the ITC. Is it clear, sir? Then can we discuss about the TDS and TCS?
Yes, sir.
Okay. Interested means I cover. Okay. I have patience also, I can cover, but you have to see your interest and all thing, how it is relevant. Okay. Now let us understand about the TDS and of course about the TCS. Some people on the waiting room, but they're not able to, I can't take the admit in the from them. Okay. Let us understand of the what is the TDS and what is the TCS. TDS means tax deduction at source. Tax deduction at source. TCS means tax collection at source. That they are both are different. Okay. So what is the difference and all thing? Let us understand. TDS, as I told you, TDS is applicable only when it's dealing with the government agencies like central government or the state government or the local authorities like municipalities or any of the government other agencies are there, like pollution control board or the some other factories act, some organizations are there like that, wherever the government agencies are there and you are making the supplies to the government agencies, central or state or the local authorities and all thing, then they will deduct tax because there are certain contractors are there. For example, municipality is there, they're awarding the contracts to the contractors, and contractors generally what they do is they make the subcontracting and multiple times subcontractings they do. And the tax related all these things, collection and these things, provisions and registration also very difficult. Because there are many chain of such subcontractors are there. And many of the subcontractors may not be having the means registered under the GST. And they claim also the turnovers also less than 20 lakhs or 30 lakhs like that means that claim. So therefore, that means tracking and compliance of the taxes is very difficult in such transactions. So what the government is did to make the availability of the tax in TDS, the tax deduction at source, the government will deduct 2% tax TDS on the transactions if the transaction value is 2.5 lakhs and above. Okay. If the supplier is making the supplies to the government or the government agencies, like as I told you, and the supply value is 2.5 lakhs and above, then the GST is applicable, when TDS is applicable. The government will deduct the TDS from your bill at the rate of say 1% CGST and 1% SCST. or if the IT GST in 2%, they deduct from your bill, okay, and they pay to the government, the GST portal within 10 days. Even the government also, different department, different accounts. So the government will make the payment to the GST portal, that is separate account, within 10 days. And accordingly, they make the TDS certificate to the supplier, and the supplier will get the credit. Okay. In case the government is not making the payment, what the deduction has happened, according the payment is not made within 10 days, then interest at the 18% they have to pay. Interest at the 18% they have to pay. Government also. Okay. And once the TDS certificate is issued, the supplier is now allowed to take the credit. What is the amount they deducted? To that extent, that amount can be get credited by the supplier. The transaction why this made is because they collected and credit taken nullifies. So the supplier is not affected actually, but why this has happened is to make all the chain of the suppliers, many of the people are unregistered and all things, to make them registered, so the transactions are very transparent. For that purpose, the TDS is introduced. Okay, so all the suppliers has to register. If they're not registered, for example, even then the government deducts the 2%, then the supplier is losing that 2%. So therefore, they're forced to register. So therefore, they comply with all the GST compliances. Okay. Mainly, this is for the contractors of the to the supplies to the government related. Okay, that is TDS. So, for example, the TDS, the contract value is at 2 lakhs, and the invoice value is 2 lakhs, but the TDS is not applicable because I told you that 2.5 lakhs is the cutoff. No, so above 2.5 lakhs only the TDS is applicable, because it's less than 2.5 lakhs. So therefore, no TDS is applicable. For example, this contract value is 5 lakhs, but the supply value is for invoice value is 3 lakhs. Of course, it is applicable. And in certain cases, even though contract value is 5 lakhs, but the invoices they make, because there is people are very clever many times to avoid the tax, they make multiple intelligence. What they do is, instead of making the 2.5 is cut off, so why we make the 2.5 invoice, we make the 1,50,000 or 2 lakhs, which is less than 2.5 lakh, they make the invoice. So please mute, sir. Please mute, sir. So please mute, sir. Please mute, sir. Some noise is coming. Please mute. Okay. Okay. So certain times the part billing is being done to avoid the tax. In such case, government what they did is not about your invoices. It is about your contract value. If the contract value is more than 2.5 lakhs, then even though you are making the different bills, that invoices, part bills, then also the tax is applicable. For example, your contract value is 5 lakhs, but you raised only 1 lakh invoice, then also it is applicable tax, because your contract value is more than 2.5 lakhs. Because if the contract value based on the tax is deducted, not based on the invoice value. Okay. Of course, you have to file the returns under GSTR 7. The government which they have collected the 2%, that file the return GSTR 7. After the filing, of course, the supplier will get the credit, and accordingly you can take the credit also. And TCS is applicable for e-commerce transactions. E-commerce transaction, what happening is, nowadays e-transaction like Amazon and Flipkart and many other transactions we are doing, there's a huge business, crores of transactions they're doing, and lakhs of crores of the revenue they're getting. But many times the tax payment and nothing very complicated. Certain times they're paying or not paying, and very difficult to track. So therefore, what they did is TCS, the provision they made. From the TCS provision, what happened is, for example, a business person is there, he's supplying to the Flipkart. Flipkart is the platform. Flipkart or Amazon is platforms. Actually, they are not making the manufacturing and supplying, but somebody is supplying through Amazon. Okay. So in such case, what they did is, these Amazon or the Flipkart, they had to collect the tax and they had to deduct actually from the bills of the original supplier. And they collect the tax and then pay to the government. Okay, this is collection basis. They collect the tax from the supplier. Any dealer or the trader selling the goods or services online would get the payment after the deduction of the 0.5% as a tax. That is, the CGST is 0.25% and SCS is 0.25%. Total is 0.5%. That has been deducted and that has been paid to the government. So here the e-commerce platform, that Amazon and Flipkart, they had to collect the tax and pay to the government. And they had to file the return GST 8. Okay. So this is the provision they made so that the 0.5% tax is being taken here. Again, the credit system is allowed again, as I told you, credit like here. Then GST are returns. Returns as when you are a registered person, returns are mandatory. And there are different type of registrations are there, like a normal registration. Then there's maybe a composite registration, the composite scheme under that registration. There are different type of other registrations are there. Based on that, there are different returns forms are there. But we are not going because time doesn't permit, but we are not going. But these are the sum I'm showing to you. Normally, generally, we are paying as GST 1. And the GST 1, you have to pay on the monthly basis, if you are a normal year. And the transaction wise, if the turnover is up to say 1.5 crore, there's a provision is made up to quarterly also, you can file the return by the 11th of the subsequent month. Okay, 11th of the subsequent month is that returns has to be filed. And GST 3B is another common year. That is summary return, we call it. And by 20th of the subsequent month, you have to pay, make the return. At this time only, you have to pay the tax payment has to be made. Even though tax is liable earlier, but payment arises at the time of the filing of the GST 3B. Okay. And various other like composite scheme, there are GST 4 and GST camp, this is the 08, and the GST 5 for the non-resident, like the different transactions are there. TDS, as I already we told about the GST, the 7 and the 6 and 7s. So these are the certain transactions you have to make. Okay. So these are the GST returns. With this, of course, okay, the treatment of exports and all thing, of course, we are not covering. Okay. So the time doesn't permit. Okay, that itself is another chapter and another subject. So with this, can we close the session? Any doubts and all thing there, we can discuss. And all thing we can discuss. Otherwise, we are going to close. Any doubts or any questions?
So it was a very nice presentation, sir, with a lot of information presented in simple.
Okay.
Thank you, sir.
Thanks, sir. Thanks.
A lot of very good slides with a lot of information. Precisely, sir. Thank you, sir.
Okay, sir. Thanks, sir. Thanks to all.
Thank you, sir.
Thank you, sir. Thank you so much.
Thank you, sir. Thank you so much.
Thanks to all of you.
Thank you, sir. Thank you very much.
Okay.
Thank you so much, sir.
Thanks, sir. Thanks to all. And I have a YouTube presentations also. If you can type in the Google search SN Panigrahi YouTube, you can have almost like more than 200 plus YouTube presentations are there on various subjects, on the project management, supply chain, then about the contracts and GST and many things are there. Okay. You can subscribe, it's free of cost also. You can subscribe. It's for the generally my contribution to the society, like giving back.
Do you find the presentation informative and useful? If yes, then click like and also subscribe the channel for free to receive updates. Thank you. For more details, contact SN Panigrahi at the below contact details.